Welcome to Your Money Matters show. Once again on Tuesday, 5 p.m. with Ripon Ray. So yes, we've heard a great deal about many different topics on this show. We've covered mortgage, we've covered universal credit, we've covered consumer credit and its act, and of course we intend on covering many more things. But what do I have on this show for you today, this week? Yes, the show is going to be divided into two parts. First, we'll be covering pension and what rights you have if you're intending on claiming pension, and also what sort of things you should be looking out for in order for you to protect yourself as a future pensioner. And of course, on the second half, we'll be covering the draconian topic, universal credit, and how it might impact you and what sort of thing you can do to protect yourself as a universal credit claimant. So to help you in this show, I have Robert Parker from Bond Wealth Limited, who is also a chair of Personal Finance Society. So are you there, Robert?
Hello, hi Ripon, it's lovely to be here.
Thank you, Robert, for attending. You have been on this show before, I understand it.
Yes, indeed. Thank you very much for having me back.
So what I actually need from you is your, no doubt, knowledge as a financial advisor. I understand you are actually an independent financial advisor.
Indeed, yes, I'm an unrestricted independent financial advisor, so we can talk about anything that you need us to talk about.
That means, I suspect, of pension.
It does.
So, I mean, before we actually go into detail or in terms of pension, I mean, break it down for us. Why do we have to worry about pension, or whether we should be saving for pension?
Well, within where we are at the moment in the UK, one of the problems that we have is that there's very little funding for people when they get beyond an age that they want to work. So when they get to an age where they want to work, across England, it's necessary to have some sort of income in the future. Now, the way that's normally done is by having a pension. And there are two sorts, as you said. One is a pension provided by the state based on how long you've worked here. The other one is based on you putting away savings over time and then being able to draw on those savings when you come to actually retire.
All right, so let's cover the first one, the simpler one. So, in terms of state pension, how many types are there?
Well, there'll be one main one now that most people would subscribe to over time, and that happens which is the basic state pension, and when you're working, you pay what are called national insurance contributions. So they're not really a sort of insurance, but they're a sort of a way of funding the state system. So by paying in, you're actually paying people's pensions right now, if you know what I mean. And that gives you an entitlement for the future for pension. You need to work for 35 years to get the full state pension.
Why is that?
Kingdom. Because you have to build up an entitlement to the pension over time. So when you're paying the national insurance contributions, you're not really paying your own contributions. They'll be paid by other people when you retire, but you're paying towards everybody else's. So what the rule is, if you pay long enough, then you qualify yourself. Normally, if you've paid more than 10 years worth of contributions, you're entitled to some pension.
Please try again in a
Oh,
moment.
It's interesting.
Oh, well,
Somebody's having trouble with the connection. Who was that?
not a probs,
That
but
wasn't us, was it? No. There we go.
well, but in terms of state pension, though, you've covered. So you have to
Yes.
pay for 35 years.
Well, a minimum of 10 years gets you some state pension. 30 years will get you what's called a basic state pension of £125 a week. 35 years contribution takes you up to £155, which is the current basic state pension.
So what happens if you don't contribute? Then what do you do?
Well, it's hard not to contribute because if you're working in any job in the UK, normally, even working for yourself, you normally have to contribute to the national insurance system. So even if you're self-employed, then when you pay your taxes, some of the tax money goes to pay the national insurance as well. So there are different what are called classes of contribution.
What are they?
Well, they're called class 1, 2, 3, and 4, and the normal ones that we would look at in this particular situation. Class 1 is for an employed person. Class 2 is for a self-employed person. Then Class 4 is a way of making up contributions for a self-employed person, and Class 3 is a way of making up contributions for somebody who is employed. And what can happen in certain circumstances, you can pay a little extra into the system so that you can actually have a better pension when you come to retire.
So, I mean, let's say you have contributed, but it's not sufficient. Then
Yes.
how does it get topped up?
Well, you would top it up in certain ways. If you would need to have worked more than 10 years in the UK system, first of all, either as an employed person or a self-employed person. Having done that, you could make, if you were employed, you could make Class 3 contributions, self-employed Class 4 contributions to increase your entitlement to pension over time. But obviously, the way that the system is designed, it's really built for people who are going to work their whole lives within the UK, and they get 35 years of contributions. If you're actually in a position that you can't work, for instance, if you're a student or a housewife, then some of those contributions are made up for you, so you can still get a basic pension.
So in what way are they made up?
They're made up for you by if you're not actually working, then the contributions are made for you by the state until you are in a position to work again through the national insurance system.
Right, so you mean if you're claiming job seekers allowance,
Yes, that would be one way.
employment support allowance, or whichever
Exactly.
other benefits that may be.
Yes.
So then what is, so the state recognises that there is no loophole or there's no gap in between
Precisely,
employment and
yes.
unemployment.
They don't want you to be in a position that you're losing out because you're unemployed and can't help it, or because you're studying. And in other circumstances because you're a housewife or bringing up a family.
I mean, there must be occasion when you have not been able to contribute towards your state pension and you're not entitled to full state pension. Then where does pension credit fit into that maze?
Now pension credit is a little different because that's actually a form of state benefit that you're entitled to receive when you retire. So if your pension isn't enough to get you up to the £155 a week level, then pension credit can actually make up that difference if you're eligible. So it's a form of state benefit, and it's it's what's called a means tested benefit. So it's based on your saving, how much savings you've got, and any other income you might have. But if let's say you're in a position that you had no savings and no extra income, then the state would make up your pension to the right level using pension credit.
Thanks for this. You must have heard of cases where single mothers or mothers might be not contributing towards.
Yes.
So, what are your thoughts on that? And could you just briefly clarify on this?
Well, there are situations. A married woman should normally still receive some benefit by virtue of her husband's contributions, and generally it's possible to make some contributions yourself towards the state scheme, but there is a possibility that people can fall through the gaps, and that's one of the things we always have to watch out for.
So in terms of mothers, what we talked about, the rule is regardless of what you think, you should apply for child benefit.
Oh yes, you'd certainly applying for any state benefit that you should be eligible for is always a good thing. It's something that's always encouraged, and if you're eligible, you should apply for any of the benefits that are appropriate to you. Sometimes they're disability benefits, like personal independence payment. Sometimes it's child benefit, which is quite an important one, and sometimes it can be the new universal credit. And in each of those cases, those are important. If you qualify for them, really, you're expected to go and apply for them. And people shouldn't be afraid to apply for them. It's very important because that will help give you your pension benefits in the future as well.
Perfect, thank you, Robert. Now, clearly we've covered some elements of state pension.
Yes, indeed.
Now let's move on to private.
Yes.
And I suspect this is where you would no doubt excel.
Let's see. Yeah.
So in terms of private pension, clearly government has introduced auto-enrolment since 2012, and from 2019, your your personal contribution will go from 3% to 5%. So would your employers. How does that actually work in practice?
Well, in practice, what's happening is that the contribution that you make from to your pension is actually deducted from your salary before you actually receive it. So what happens is that the payments come out of your salary as you're due to be paid before tax is taken and before national insurance is taken, and then those payments go into the public purse. They go into a fund. Ultimately, that helps you. I actually correct myself with this particular pension. It doesn't go to public purse. It goes into a pension scheme, which is approved, let's say, by the government or approved by the pensions authorities. What happens then is that builds up a sum of money for you based on your employer's contributions and on your contributions. And ultimately, if you've put away enough, that helps you fund your retirement in future, because it gives you a fund of money which is tax-free, and then when you contribute to it, it's coming from before tax is taken from your pay, so you're gaining in all ways. For an employer, it's a business expense, so again, there's an advantage to the employer. It saves them tax and other things. And ultimately, then, you build up a sum of money inside that tax-free fund. Then, when you come to retire, you can actually take some of that money, you can take a quarter of it tax-free, and then take the rest as an income or in lump sums as you want. But that second part is subject to tax.
Okay, I mean, although clearly contribution is being made to save for future, so when the money is being invested, where is it being invested?
Well, it will be invested in a number of funds, let's say, which are there to actually, probably the nearest equivalent. Sometimes the Americans talk about something called a mutual fund, but that's often an internationally recognized word. But what happens is that the money goes into pension funds.
Mm-hmm.
The pension funds themselves, there may be several choices in certain circumstances, there may not be, but depending on the funds that they go into, those funds will perhaps, using a little bit of stock market performance and deposit performance, sometimes gilt-edged securities, which are government securities, government bonds, if you like. With all of those...
So you mean government IOU?
It's a bit like a government IOU, yes, that's one way of thinking of it, yeah. What would happen is that you then get again, the money you put in, then you hope would grow when the markets grow and things change, and that helps you have a little bit more money when you come to retire.
What are the risks involved in investing in such a way?
Now, if you're investing, let's say more generally, into a pension, one of the risks that you must always face is how much the fund might change in the stock markets or in other markets, because in normal pension investments they rely on certain sorts of market or certain sorts of investment, most of which will change in value over time. So for instance, if you look at the UK stock market at the moment, it's today has fallen by about 0.5%, as we're looking at various things to do with Brexit. Now, that could well, tomorrow, it could grow again by 0.5%. So the markets move around. And what you hope to achieve over time is that the stock markets or the various things you invest in grow in some way, and that they grow to help you have that extra bit of money that you need to retire. So in other words, you don't have to put in all of the money that you finally draw on. You put in a proportion of it, and if it grows well, then you have more to draw on later. But one of the risks, of course, particularly if you're investing just for a short length of time, which is always very difficult to do, is that markets can rise and fall in those circumstances. And sometimes, if the market's fallen, you might want to wait before you took your pension.
Why is that?
Because the fund might be worth less than you want it to be when you come to take the money out.
I mean, I thought the whole idea of investing in pension is to think about long term.
Oh, yes.
15 years, 20 years. So if it wobbles or topples now, should that make a difference?
Over the long term, we'd like to think it doesn't. All the studies that we have show that if you invest for something for the long term, you actually see them grow, the investment grow over time. That, of course, is something that can't ever be guaranteed because there can be situations. For instance, there was the Wall Street crash, the 1930s depression. In other words, things that happened in the stock markets over the years. And if you'd wanted to take your pension just at that time, it would have been better waiting. We had something called Black Monday that happened in the 1980s, where the stock markets abruptly fell during a few days. What actually happened subsequently was that by the time you got to the end of the year, the markets had come all the way back up. So stock markets generally, or investment markets generally, because the assets the things underneath that actually are earning the money, they always have to pay enough to make sure people want to have them, if you know what I mean.
So, I mean, go ahead.
Yeah. So what it really means is that you can generally, yes, things grow over time, but you can never guarantee it.
Sure. So, in terms of overseeing investment,
Yes.
in terms of from the point of view of a regulator, who would regulate or oversee the work of institution in the context of pension funds?
Well, there are several things there. The Financial Conduct Authority regulates a great deal of the pensions market. So anything relating to a private pension or a pension bought through a company would be the Financial Conduct Authority. Now, there are certain state authorities that will, and we can think of several. I think OPAS is one of them that comes to mind. Again, that's a state body which helps regulate public sector pensions or pensions which actually are coming from bigger companies where you get a proportion of your final salary from pension rather than the amount of fund. Those last pensions now are much rarer than they were. But there was a time, particularly in England, that if you went to work for any of the big companies, say you went to work for ICI or the post office or anywhere like that, what they did, instead of you building up a fund of money to draw on, they actually said, well, what we'll do, the company will pay you a pension when you retire, and it will be based on how many years you've worked and what your salary and job was when you finished. And that was called a final salary scheme. Those are much rarer now. The most modern pensions that people will see today are based on putting money in, on hoping it grows and expecting it to grow, because that's quite reasonable. You should expect it to grow, and then drawing on the fund of money at the end.
I mean, the way things are now, it appears to me there'll be a number of, I suppose, pockets of pension pots, isn't there, for individual?
That's right.
So in order, let's say for me, to find out where my pots of pension pockets are, how do I go about finding out?
There are several ways. One of them is that, now, I think I shall actually go down a little bit of a list for you, Ripon.
Yeah,
I may.
go ahead.
So first on the list, if you want to know if you're qualifying for a state pension and how much state pension, there's a state form you can get from the internet called the BR19 form.
BR19?
It is, yeah. And if you fill that in, or even you can do it on the internet now, if you fill it in on the internet, you need to know your national insurance number in the United Kingdom, which is the one with the 2 letters, 6 numbers, and then a letter after it.
National insurance number.
See on your tax, and you see it on a pension document, for instance, if you're getting a statement about pensions. If you send that off, or you fill it in on the internet, that will tell you how much your state pension is predicted to be, and then you'll know if you can make some extra contributions to it. If you've got a private pension, one of the ways of looking into this now is to just look at different places that the pension might have gone to, if you know what I mean. Now, if you've done that by contributing through a company, if you write to the company itself, if they're still there, then you can actually trace the pension. Another way of doing it is that you can actually go, if you knew the companies that the pension was actually invested with, you can contact the investment companies and they'll tell you as well. So often you will find there's lots of little pots settled around that you can actually draw on in those circumstances. Sometimes when you retire, you can put them together. Sometimes you can get them paid to you straight away with special tax rules. So it depends. Yeah.
Well, actually, you kind of took me towards my next question. Government, no doubt, recently has loosen the, unlock the pension.
They have indeed, yes.
So
Yeah.
how does that work in practice?
Well, the government in a few years ago actually introduced something called pensions freedoms. And what pension freedoms actually are is that if you have a private pension, you have a right to actually say, well, I'm actually going to take all of that pension now if I want to, or I'm going to take a big chunk of it, or I'm going to take some income, I'm going to take whatever I want out of it. And what the rules actually say is the first quarter of the fund that you take is free of tax. The remainder,
That's 25%.
that's 25%. So first 25% is what we call tax-free cash or pension commencement lump sum. If we're financial advisors, we say that. We call it PCLS. So what actually happens is you can take that first bit. Now, with some people, there are special rules, they can take a little bit more. But generally, for everybody, pretty much that you would ever meet, is 25%. So what would happen is that the first quarter, 25% is free of tax. Everything else is subject to tax. And the amount of tax you pay depends on the income that you've got, and how they deduct the tax at the beginning depends on how big the sum is you take out.
Give me an example.
Oh, so an example, if you had a pension fund of 100,000,
Yeah.
and you drew out 10,000 in one go,
That's not subject to tax.
that wouldn't be subject to tax. Okay, so you could draw out another 10,000, and that wouldn't be subject to tax.
That's 20%.
And another 5,000, and that still wouldn't be.
Yeah.
Now, if you now want to draw another 5,000 out in one go,
That's 30, isn't it?
yes, 30. So you've gone over the 25% tax-free cash now. What would actually happen is you'll be taxed by the company based on what your tax should be in the UK. But if they don't know, this is where it gets tricky.
Right.
What happens if they don't know? They tax you on what's called a month one basis, which is the basis that if you imagine if you were doing a job and nobody knew you, just walked in and started doing the job.
Yeah.
They take out the most tax they can because they don't know what tax you're going to pay.
P60.
It's like a P60, yes. A P60 is something that tells you how much tax you've paid. And somebody who goes to do a casual job is taxed on what's called a month one basis, or sometimes a week one basis, depending if they're paid weekly or monthly. What happens then is that they take at least 25% tax, sometimes more, depending on what the job is and what you've done. Now, just in the same way, if you've come to a pension scheme and you want to draw £5,000 out in one go, they don't know if you're going to draw out 5,000 again in another month or 5,000 another month. So they'll tax you as if you're going to do that. And that's called month one taxing. And that means you pay much more tax in those circumstances than you would if you'd been just taking small regular amounts. Pensions are really designed to take small regular amounts of income out so that you've got it for your whole life. But you can have more out if you want. And if you have more out, then you'll pay more tax first, but then of course you can reclaim it after. The only thing from our experience is it'll take you probably at least 12 months to claim it back again.
Right. Well, I mean, Robert, since we're nearly coming to an end of the first half, what advice would you give to future wannabe pensioners?
Oh, well, there's really no way round it other than to say it's vital now that you put money away into pension. It's absolutely critical that you do. It's a very good thing to do from a point of view of tax and savings, because if you put money into a pension scheme, then imagine you put in, let's say you put in £8 into a pension scheme. The government gives you the tax back on that, so that you end up with £10 in the pension scheme. So that means on the first day you put the money in, your money is actually grown by 25%, because you put in 8, you've got 10. So they put the other 2. That's like 25% growth in one day. And of course then the fund will grow as well in a tax-free fund, and you only worry about tax currently when you actually take money out. But the big message is that you must save now for retirement, because really in the way that the modern systems are working, what you save for retirement is going to make such a big difference to your lives, and you'll be able to pay for things that you need and keep your standard of living going.
Fantastic, Robert. Thank you for joining on Your Money Matters show. I'm sure I'll be seeing you frequently on this show anyway in the future.
I look forward to it.
Absolutely. Thank you, Robert, from Bond Wealth Limited and Chair of Personal Finance Society. On this note, ladies and gentlemen, we'll be taking a brief break until you'll be hearing from me again, and I'll be talking then about universal credit. There we are. And members of the public summed it up. But let's not forget that it is here to stay. So yes, some of the questions that I will try to answer is, what is universal credit? How does it work? If things go wrong, how you can fix it? And of course, the way you learn to deal with online universal credit. So yeah, there's a lot to talk about. So I will be talking literally for the next 30 minutes. So yeah, what is it? Well, it is basically benefit that is designed when you are dependent on means tested benefit or income related benefit. Not contribution based, not non-means tested, but income related benefits. So in other words, you have no money, you need money. How do you get it? Do you apply for universal credit? So that's kind of what it is. So things that are included is what I want to give a list of, yes, things that are included. It includes if you need help with children, that will be child tax credit. If you need help with your home and your rent, that will be your housing cost element. If you need support with income support, that would be also covered. If you are looking for a job, then obviously you need to apply for universal credit. And of course, if you can't get, let's say for example, you can't work because of your ill health, then you might need also money. So all those things will be covered under standard allowance, but also your other things like your limited capability for work or work preparation or work related requirement. Those are things are included, as well as your working tax credit and carers allowance. There are a number of things that are included, but the main 6 one, let me just repeat: children's child tax credit, housing element, job seekers allowance, employment support allowance, income support, and housing element, and working tax credit. Those are by default is part of universal what? Credit. And let's say if you're getting all these benefits currently and not on universal credit, or not thinking of making a new claim, you will be carrying on receiving those benefits. Okay, so let me repeat just so you know. Old benefits that you're getting, you will be carrying on getting, and new benefits if you need, you might have to think about making a new claim. This is when you have to think about whether you claim universal credit or you don't. However, since we talked about things that are part of universal credit, now things that are not part of universal credit, I think that is also what I need to cover briefly for your benefit. And these include, yes, these include, you may think it's quite trendy, new style benefits. Yes, new style. New style benefits in this case, where if you had made national contribution whilst you're working, for example, and there are 2 new style benefits. One is contribution based job seekers allowance. The other one is contribution based employment support allowance. That basically where you will personally get it if you have been working and currently you can't work because of your contribution from your work or due to your work. You are now thinking, okay, I need support, financial support. How do I get it? You don't apply for universal credit, but you actually apply for job seekers allowance, contribution based, or you apply for employment support allowance, contribution based. Now here is the problem. Here is the problem. Although, yes, you made your contribution, through your national insurance for many years, I hope, and then you're thinking of making contribution-based job seekers allowance claim and also employment support allowance claim, yes, there's not enough money, is there? Unless your spouse is working and he or she is getting lots of money. If not, you're going to have to find money elsewhere. This is the problem, isn't it? When there is no money and you need to top money up, then you're going to have to think about applying, I'm afraid, no way of escaping, universal credit to get housing element. Okay, so you still need your rent being paid. If you are not claiming housing benefit and not claiming housing benefit, and you've worked and you're getting contribution-based job seekers allowance, contribution-based employment support allowance, you may need to think about claiming housing benefit. But since you are not getting housing benefit, you may have to apply for universal credit to top up. Okay, but with contribution-based employment support allowance, contribution-based job seekers allowance, you will personally get it, whilst universal credit, you get it as part of a family unit. Either you have children, wife, living together in a home, all a part of a family unit, you'll be getting it. However, new style benefits are by default not part of universal credit, because universal credit is based on income base. If you apply for contribution based job seekers allowance and employment allowance, that's not income based, that's based on you making national insurance contribution. Okay, so yeah, new style benefits not part of universal credit. There is more. Yes, non-means tested benefits are also not part of universal credit. Okay, so those benefits include disability living allowance, and if you're still on disability living allowance, you are still on disability living allowance. Also, personal payment, independence payment, that is not also part of universal credit. Attendance allowance are not part of also universal credit. Carers allowance, although not part of universal credit, but you may be included as carers component. There is a carers component, but by default it's not part, but it's a separate one. We leave that for another time. Okay, so carers allowance by default not part of it, guardians allowance not part of it, child benefit not part of it, and let's not forget council tax reduction is not also part of it, and you will have to apply to your local council to get council tax support. Okay, but universal credit does not support you with council tax benefit. Okay, so now, although I talked about things that are in and things that are out of universal credit, let me briefly now tell you about things that are exempt. So okay, so let's not get confused with things that are out. Also, exemption is out, but where you can still receive in an old style way in your new style situation is what are we talking about, and it will be in the context of exemption. Yeah, it's gonna be exemption. So yeah, let's say if you are in exempted group, then definitely you're fine. You seek advice from your local citizen advice bureau to find out whether you are part of the exempt group, or I would suggest you check, turn to us online to see whether you qualify as an exempted group. And the list could be exhausting, but let's find out. For example, if you're a person of domestic violence, it could be one. It could be also, let's say, for example, if you in supported housing, that might be another one. So really, we are dealing with someone who is in a very vulnerable state, and I suggest you seek advice from Turn to Us online or your local citizen advice bureau to find out what you are entitled to and what not. And obviously, before you press the right button and think that, oh yes, I am a victim of universal credit, I suggest you seek advice first before you apply, because you never know. Options are broad range, and I wouldn't want you to feel that you're making the wrong move where you get less money and you find yourself in financially difficult situation. Feel free to call in if you want to. 0208 472 8415. I will be covering universal credit, so carry on. Give me a call. Otherwise, I'll be just carrying on talking about exemptions. Yes, people who are in temporary accommodation are exempt from a universal credit. You only need to apply for housing benefit, which means contact your local council to make a claim for housing benefit on the basis that you are in a temporary accommodation. Okay, you're included. And let's not forget, if you are of above state pension, or you are of state pension, or you've reached state pension, then universal credit doesn't apply to you, because universal credit is really for people who are of working age. Okay, working age, and also based on your means. You need the money. You haven't saved up. You have made no contribution, or contribution period is over. Then you need to think about ways to claim. You'll be claiming universal credit. But people with an existing or recent claim where you are getting severe disability premium, you should not be claiming universal credit, because you are a special category of groups. And if Department of Work and Pension or Job Centre say that you should be claiming universal credit, you must challenge them, because you shouldn't. You should be claiming old style benefits. Old style in this case means either income based ESA. Usually old style benefit means old style contribution base. I'm using it in a wrong way, really. I should be saying something like old type of benefit, employment support allowance, for example, because severe disability premium, if you had it, you should be carrying on receiving it. There's been a recent court case around it where the government lost this case in court, so obviously you should be carrying on receiving it, otherwise it puts you in financial difficulties. However, that rule doesn't apply to only new claimant who are thinking of making a universal credit claim and never had disability premium. You won't be getting it. It's only for those who had disability premium and they were carrying on getting disability premium. Okay, so that's that in the sense of exemption. Now the question is, how do you get into universal credit? Yeah, it's there are three ways overall to get into universal credit. First is, of course, you're a new guy, you're a new claimant. You've never made a claimant in your life, and it's time to think, oh God, I need to pay my bills, and lost my job, and I never claimed benefit in my life. It's time to claim. So then I'm afraid you have to claim it. Yeah. So the last phase was in December 2018. So everyone and anyone throughout the country are thinking of claiming state benefit. You're gonna have to claim universal credit. That's you. The new claims, the new claimant. That's one way of getting into UC. The other is natural migration. This is where, for example, let's say you've had a claim. Yeah, you've had a, ESA, JSA, income support, whatever, right? And then let's say, for example, your circumstance changes. When your circumstance changes, let's say, for example, you move from one local authority to another, but you're still a job seeker. Then the local authority where you're going to, they'll say, hang on a sec, we don't recognize that you're going to have to make a claim, because your situation means, because we don't recognize you, you have to make a fresh claim. And then, of course, it's a natural migration. Okay, that's a natural migration to natural, I suppose, you claiming universal credit. So yeah, new claims, natural migration. Now here is the next phase that we're now going to face, because everyone and anyone who's going to be making a claim now has to make universal credit as their claim. Okay, so now the third bit is what we were all waiting for, but government decided to delay it, but not too long or too far enough. It's meant to be starting in July 2019, but a government decided to delay it until 2020. However, the government is going to test the managed migration, where basically the government will say you better move from old benefit to new benefit, basically. But the government has decided to put on hold until they've tested the managed migration as well as scheme with 10,000 people. Okay, so it depends upon where you live. Once they've tested it with 10,000 people and reviews the outcome, then they may consider actually looking into others. But currently, you're not going to be seeing any changes if you are currently in receipt of old benefits. Okay, so there we are. But of course, if your circumstance changes, there may be natural migration that you need to think about. Or of course, if you're thinking of making new claims, then I'm afraid there's no way of escaping except for making a claim for universal credit. Then the question is, how that would manage migration would work. Although it's a long way, let's be frank about it, it is a long, long, long way. So how would it work? Yeah, I know, I'm bombarding you with lots of info and yeah, lots of information. It is difficult, but what can I say? The topic that I'm covering is very difficult. So, to make it easier for you, now I'm going to be talking about managed migration and UC and how you'll be notified in 2020 unless you're the victim in 2019 in July. It will be DWP. Yeah, DWP, the Department of Work and Pension that gives you money, will send you a migration notice. It will say migration notice. Yeah. So we sent to existing claimants. So let's say if you are getting universal credit, sorry, not universal. I know the topic is universal credit, but I mean employment support allowance, job seekers allowance, income support, working tax credit, housing benefit, all those 6 benefits that I talked about that universal credit covers. Then they will say something like, okay, you need to you will no longer be receiving old benefits. You need to move to new benefits, and they'll give you a deadline. And say from then on you have to claim, and of course after that deadline you won't be receiving any benefit. The old benefit will stop, and you have to make a claim. Basically, you make a claim yourself. Then the question is, how will you apply? Yeah, that's the bit, isn't it? I'm afraid is applying online. You're gonna have to apply online, yeah, and sign in to your universal credit account, and you have to use that account. You have to go online, and you probably have noticed that, yeah, libraries are full, and citizen advice bureaus are busy trying to help people out to make your claim for universal credit. That's why it's online. So yeah, so you apply online for a number of reasons. You apply online if you want to make an advance payment. We'll talk a bit later. If you want to see your statement in terms of what you're getting and when and how and stuff like that. And if you want to report any change of your circumstance, you can do that as well, because you've got an online portal that you can use to really make your claim and tell them about your change of circumstance. If you want to add a note to your journal, you can do that. See also your things that you need to do, and don't forget, of course, your payment and when will you be getting your next payment, that too. And no doubt, if you are receiving universal credit on the basis that you're a job seeker, you're going to have to check your claimant commitment, don't you? So there we are. So you need to think about those things. Yeah, so that's kind of how it works. I'm afraid it works online, no doubt. Now clearly there has been controversy. Let's not hide behind bushes. There has been controversy around universal credit. But the question is, what? Yeah, so yeah, I'm afraid, according to Trust on Trust, it's the charity that kind of gives food to people who just can't afford to buy food. They basically run the food banks throughout the country, and they have basically said, and please Google online and you see it because literally I pinched their data. It says on average, 12 months after rollout of universal credit, food banks see a 52% increase in demand compared to 13% in areas with universal credit for 3 months or less. So basically, of course, wherever there's universal credit and it's been there for longer, use of food bank dramatically goes up. Now here's another shocking stats. Now in Tower Hamlets, that's actually the data that I'm providing you now. It comes from the Parliamentary Select Committee, which showed that 83% of universal credit claimants who are also local authority tenants are in rent arrears since March 2017. So clearly, in terms of data, it looks quite bad. But now let me just move on to government data. What does government data shows? I'm afraid it shows, it shows that there has been a huge rise in sanctioning. That's government data, DWP data shows that there's a huge rise. So, for example, 2.8 of people had a drop in benefit due to universal credit sanction in 2018. Compare that with Old Style is only 0.3, and employment support allowance 0.1. So naturally, the tactics and the approach used by the government on universal credit is also quite draconian under universal credit. And according to a local National Citizen Advice Bureau, 38% of all universal credit decisions resulted in benefit sanction, and 71% of these are due to not attending interviews. And clearly, when you find you're in just a tough situation, there are things that you could do, but I'll cover that a bit later. So, and it's probably is now than later, isn't it? Yeah, so in terms of appealing, I'm afraid you're going to have to think about challenging DWP, and that will be involved through mandatory reconsideration, and which is basically saying, look, DWP, I don't believe with your decision, whichever way it is, I am appealing. The other one, then you, if that's not successful, you take it to your Social Security Tribunal, and then of course, third, it's going to be through second-tier tribunal where you can get legal aid for your appeal. That's one way. That's if you legally you challenge it through mandatory reconsideration and then take it to first tribunal and to your and to second tier tribunal. The second way would be if, let's say, for example, your claim is delayed, and you want to think about complaining against the delay. You can complain to complaint resolutions manager due to delays. Okay, you can do that. The other thing is, if there is no options in terms of mandatory consideration, or let's say, for example, complaint resolution manager, you might have to think about judicial reviewing the decision. But to do that, you need a lawyer. Okay, so you need to think about having a lawyer, and hopefully the lawyer will help you out. Okay, so now quickly, I'm running late, obviously, not much time. How can you deal with financial difficulties and universal credit? First is advance payment. Yeah, advance payment. Yeah, let's recap. Strategies in dealing with universal credit. You'll be applying for an advance payment, that's one. Second is alternative payment. Now, if you are in rent arrears, if you think you can't deal with your money, and if you want to be safe, please go and tell DWP is a way of doing it, but just do it. Say, I want you to pay my rent money to my landlord because I can't deal with it, okay? It just takes pressure from you, man, okay? And of course, if you're really broke, you might want to think about applying for advance payment, and that's basically you getting money up front because you have not received it for so long, okay? There are other things, budgeting loans. There is a council tax discount you might want, and of course discretionary housing payment. And if it gets too worse, you might have to think about food bank. So okay, folks, so now clearly we have no doubt come to an end of this show. So just kind of recap in terms of what we talked about. We've talked about a lot. We talked about pension. We talked about state pension and how you get it and how you save it. We talked about also work pension enrollment, private pension, investing on pension, and also why it is important to save for your pension. Okay, so you should be a guru of pension now because Robert Parker from Bond Wealth Limited told you about it, the guru on pension. Then I talked about universal credit and how you deal with the universal credit, what is part of universal credit and what isn't part of universal credit, and how you sort out the problems related to universal credit and complaints and appeals and all those things. Okay, so I'm afraid I have now come to an end, so I have to say goodbye to you and hope to see you shortly. And in the meantime, I would like to say is what can I say? See you next week when we'll be talking about more things with money. And if you want to get in touch with me, well, Twitter, Ripon as Ray. Okay? Take care on your Money Matters show with Ripon Ray.